Hi, this is Ed Jorgensen with our Outlook 2018 March edition. I'll do an updated outlook each quarter. Times change, and they're likely to change a lot. Let's start. As you know, in the past year, investment markets have rallied on hopes for pro-business tax proposals from Mr. Trump. In late 2017, his huge tax for business sent stock markets even higher. But now investors wonder if interest rates will climb as part of the cost of paying for the tax cut. So the Trump rally here in early 2018 faces its first uncertainty. What are we to make of this? The Trump rally looks like a bubble, but is it? Let's take a look at some interesting past markets. In 1954, 25 years after the great crash of 1929, famous economist John Kenneth Galbraith testified in Congress that the spectacular post-World War II rally looked a lot like 1929, and it certainly did. But bubble worries proved wrong. Stocks surged for many more years during the Eisenhower and Kennedy administrations, rising over 100% beyond the levels that in 1954 investor Galbraith had testified looked like an imminent market crash. Of course, the most famous bubble call of all was by Federal Reserve Chairman Alan Greenspan in December of 1966. I bet you remember this one. Chairman Greenspan wondered if stocks weren't irrationally exuberant after a huge two-year rally in 1995 and 1996, with the Dow gained 100%. But instead of crashing, the markets gained another 100% in the late 1990s as part of the year 2000 tech stock rally. On the other hand, sometimes the surprise is a totally unexpected crash. In June of 2007, Goldman Sachs chairman and Treasury Secretary Henry Paulson said that the world economy was enjoying a synchronized recovery that made him bullish, really bullish. Well, 2 months later, tremors in the London banking markets foretold the horrendous crash of 2008-2009. It turns out that Mr. Paulson's interview with Fortune magazine in 2007, heralding the synchronized world recovery, in fact marked the top of the market. And no one knew. So let me give you some thoughts on our portfolios, but first some reminders. As you know well, and our historical charts show, past performance is no guarantee of future results. I would add, these are bizarre times, with conflicts in Washington even more extreme than the usual party bickering. Still, we have to make decisions and strike a balance in our portfolios. So let's start. My comments, sure, this is a speculative rally, and you can see it in the divergences. Stock prices have gone up a lot in the past year, but bonds have fallen in price just as drastically. This reflects worry that the low interest rates of the post-2008 crash cannot continue as the federal government raises spending and cuts taxes at the same time. Other income investments, like bonds, have suffered. They are not participants in a speculative stock rally. Real estate stocks, one of the few investments paying decent income in this cycle, have totally missed out on the recent stock market rally. Now, partly that reflects problems in malls in an online world, but even warehouse distribution stocks that are serving the online world, while they may have done better, are still falling badly in 2018. Also interesting is that the great stock market rally has largely been centered in the United States. Look at this index of stocks in Europe, Asia, Japan. It's really only a bit above the 2007 peak, which leaves you wondering, how will that divergence be resolved? Will the rest of the world catch up with the United States? Or will the United States correct? Well, let's look at the fundamentals. The greatest support for investments in the United States is today's low oil prices. In 2007, sharply rising oil prices derailed an expansion. Today's prices are rising again, but are far below levels that crushed the economy 10 years ago, half the levels. That is a tremendous support to the US economy and to the US stock market. Unfortunately, there are winds of war in the Middle East, as Iran, Saudi Arabia, Israel, and Hezbollah are arming for conflict. In my opinion, war is more likely in the Mideast than in Korea, and could even break out this year. So let me sum. In my view, US stocks are expensive, but expensive markets can persist for years. The risk here is not really valuation. I mean, over the long term, it's valuation, but over the next year, the risk is the thought that the Federal Reserve Board might raise interest rates substantially, in my view, rates 1.5 percentage points higher than today, while they would still leave interest rates quite reasonable in historical terms, would nevertheless send US equity prices down 6,000 points. And that's because stocks have enjoyed the juice of extraordinarily low interest rates. And some of that juice would be taken out by even normal interest rates. On the other hand, I suspect that should stocks begin to crack from the pressure of rising interest rates, the Federal Reserve Board will back off raising rates as it has several times in the past 10 years. The Federal Reserve Board and the Treasury Department are of the opinion that high stock prices help the economy grow. And while they would tolerate some correction in stocks, I suspect they would get very nervous faced with a major decline. So all things being equal, I maintain a variety of stock holdings. For stocks, I seek established companies that have the ability to raise prices in today's economy. I know this is called a low inflation economy. I believe inflation is headed higher, and I think it's probably higher now than the government reports. I want investments that can translate that inflation into higher prices. Let's think of McDonald's really in a sense, a staid company that has the stores it has. But the stock price has soared in the past year and a half. Why? Not because people ate more hamburgers or McDonald's opened so many stores. McDonald's simply raised prices, and raised prices a lot. and that translated into higher profits. That's the kind of pricing power I'd like to see in all our investments. And now, although real estate stocks have performed miserably for years, I think we should invest in them now. Look, of course, we hope to avoid being a casualty of the Amazon online preferences of millennials, but maybe even that is changing as we speak. I suspect that recent demographics are shifting, with millennials marrying, albeit late, and having kids, albeit late. Families with kids tend to have a different lifestyle from urban singles. Families with kids, if we have that sort of boom, would support residential real estate prices in the suburbs, shopping and distribution. With stock prices high, I believe that all portfolios need regular income coming into the portfolio. Look, if you're a family that's drawing a lot of income out of the portfolio and you're not earning any income in the portfolio, you're just depending on rising stock prices, what happens when stock prices fall? I know it's been a huge run in the past 10 years, but cycles come and go, and God forbid you have to liquidate your portfolio at falling prices in order to get your annual income. In a speculative market like this 20 years ago, we would have had 30% in money funds and CDs and earned that income. That would have been safe income, stable income. And then we could have let a portion of the portfolio stay in the market. Unfortunately, money funds and CD rates are still extraordinarily low, and that is dead money today. All things considered, as I said, I'm going to look for real estate instead as an income investment. Well, and also as a cautionary hedge in case industrial and technology stocks take a hit. It's been true in past markets that sometimes real estate stocks and industrial stocks perform a bit inversely. Not always, but it's reasonably likely. Plus, I do fear inflation, perhaps more than others. And I hope that the real estate will hold up if investors begin to see inflation as a risk. How about municipal bonds? Municipal bonds have already suffered in the past year and a half, a lot. Now, I'd say they have suffered about 60% of the price decline I would expect in this cycle. Still, at this point, I don't anticipate gains, more likely further price declines, partly offset by that very nice and reliable tax-free income, particularly if you're in a high-tax state and your taxes are going up, which they are. And I might add that if we have a Mideast war, in that scary scenario, I think bonds would likely rise as a hedge, as a safety hedge. Well, it's a balance. Some bonds in a portfolio, it seems to me, are okay as a hedge. And I know that many of you like your bonds, remembering when they paid you income when stock markets took that miserable hit in 2007, 2008. The other hedge I like is oil and gas stocks. Now, this is a little tricky because These stocks are dull at $60 oil. They might pay some income, but they're not going anywhere. They'll suffer badly at $45 oil as they did 2 years ago. But at $85 oil, they will soar while industrial and technology stocks decline. Because just as low oil has been the great support of this bull market, high oil is the great threat. So oil and gas stocks that benefit from high oil, are likely to rise in precisely the scenario when industrial and technology stocks fall. So again, oil is a hedge. These days, my preference is to have a portfolio with balance. It's always my preference, and quality, and that's my preference too. Including substantial cash income and hedges. Now look, I know that in a melt-up Trump-style market, that hedged portfolio will earn less than an all-stock portfolio. It's obvious. If the Dow Jones is going straight up, anything you do to hedge against the decline is just going to cost you. And you'll earn less than if you simply owned growth stocks. A hedge is just that. A hedge is something that pays if over the course of 2 to 3 years, the rising market of the last 10 years falters. But it's a balance. It's a trade-off. So each of us has to consider our view of the next year, the next few years, our sense of the opportunities of risks. Let me know your thinking. Let me know your comfort. There is no one right answer. There's no one certain answer. I mean, you look at those stories from John Kenneth Galbraith in 1954, Alan Greenspan in 1996, Hank Paulson in 2007. Really, America's most sophisticated, most brilliant economists and bankers and analysts, and they got it wrong. There is no one right answer. There is no one certain answer. Let's come up with a portfolio that makes you comfortable and works for you. Well, thank you very much. Best regards, and we'll be talking.